Welcome to vTalkInsight, Risk Sentiment Daily for January 23, 2026. Global markets are leaning back toward risk-on, but under the surface we see deep structural fault lines from de-dollarization to AI exuberance. Let's unpack what is really driving today's cautiously optimistic tone and where the key downside risks are building. Across assets, today's picture is best described as cautiously risk-on. U.S. equities are firmer, with the S&P 500 up around 0.5% and volatility drifting back toward the mid-teens, signaling a modest rebuilding of risk appetite after the recent bond scare. Stronger U.S. macro data, resilient earnings expectations, and enthusiasm around artificial intelligence are encouraging investors to add back risk, especially in equities and credit. At the same time, heavy use of hedges and options, steady demand for short-dated treasuries, and structural bids for gold show that investors are doing this with one hand on the risk-off switch. On the constructive side, the U.S. economy is surprising to the upside on both growth and disinflation, while an AI-driven capex and productivity cycle is creating a powerful multi-year demand story in technology, energy infrastructure, and critical materials. Market breadth is improving as small caps, transports, and cyclical sectors outperform, suggesting the rally is broadening beyond a handful of mega-cap tech names. Balancing that, several medium-term risks remain front of mind. De-dollarization and changing reserve preferences are eroding the unquestioned safe haven status of treasuries. Bond market volatility is increasingly driving equity swings, and geopolitical tensions from Ukraine to the Arctic continue to lift risk premia, especially in energy and supply chains. Put together, the balance of evidence points to a risk-on environment, but one that is actively hedged and highly selective. Investors are willing to pay for growth and for structural AI beneficiaries, yet they remain acutely aware that higher-for-longer yields, geopolitical shocks, or an unwind in crowded trades could trigger sharp drawdowns. Against that backdrop, today's key forces cluster around three bullish themes and three offsetting headwinds. Let's start with the dominant support: robust U.S. growth and disinflation. Robust U.S. growth and disinflation remain the backbone of today's constructive risk tone. Weekly jobless claims are running near 200,000, pointing to a labor market that is softening only gradually rather than collapsing, and near-term recession risk looks contained. Growth data are consistently beating expectations. Third-quarter GDP was revised up to about 4.4%. More recent estimates point to growth above 5% with inflation near 1% over the past 3 months, and major banks have lifted 2026 GDP forecasts toward the high 2% range. Crucially, the consumer is still spending. Personal consumption has been growing around 5% year over year, real wages are rising despite tariffs, and banks expect earnings growth to run in the low double digits as strong nominal GDP flows through to corporate revenues. Inflation trends are also moving the right way. Core measures show a clear disinflationary pattern, with some analysts expecting downside inflation surprises through 2026, helped by softer shelter and food prices. The Federal Reserve is widely expected to stay on hold for now, with little priced in before midyear, which effectively gives markets a stable policy anchor while the data evolve. This combination of above-trend growth, easing inflation, and policy stability is supportive for risk assets, particularly U.S. domestically focused companies and credit markets, where income generation is a key draw. The main risk to this driver is that strength overshoots. If growth stays very strong while deficits remain large, term premia and long-end yields could reprice higher, undermining equity valuations and the diversification role of bonds. The upcoming personal consumption expenditures inflation report, wage data, and signs of stress among lower-income borrowers will be important checkpoints for whether the Goldilocks narrative can persist. The second key bullish force is the AI-driven capex and productivity boom. Technology leaders are signaling an unprecedented investment cycle. One major chipmaker's chief executive talks about trillions of dollars of new AI infrastructure, while forecasts for global data center spending rise from roughly $500 billion to over $1.4 trillion in just 5 years. Large tech firms alone are expected to deploy more than $1 trillion into AI infrastructure over the next 3 years. Current U.S. AI investment is only about 1% of GDP, well below the 2 to 5% range some see as needed for full-scale transformation, which implies significant further capital deployment if the thesis plays out. Early adopters are already reporting tangible returns. Some enterprises see close to a 2.8 times return on AI investments in a short period, particularly in software engineering, customer service, and legal workflows, which is fueling broader corporate commitment to scaling AI across functions. This capex wave is spilling over far beyond semiconductors. AI data centers require vast amounts of power and materials, boosting demand for natural gas infrastructure, electricity grids, aluminum, and critical minerals like copper and uranium that have suffered a decade of underinvestment. Macro forecasters increasingly build this into their long-term views, with some expecting nominal U.S. growth and productivity to run well above historical averages and real GDP growth potentially exceeding 7% annually by the end of the decade, driven by disruptive technologies. At the same time, this story is not without risk. There is intense competition, signs of overinvestment, and a clear gap between AI's theoretical potential and the incremental improvements most firms are seeing today. Over the next year, markets will likely focus on which companies can convert AI spend into durable earnings and how credit markets absorb a rising wave of AI-linked corporate debt issuance. Third, the equity rally is broadening and rotating, which supports a healthier risk backdrop. Small caps have outperformed large caps for 14 consecutive sessions, with the Russell 2000 and the S&P 600 up around 10 and 8% year-to-date respectively, and transports are also leading gains. Investors are rotating out of crowded mega-cap tech into underowned, lower multiple sectors such as energy, industrials, and materials, which have posted strong early-year performance. Market breadth across diversified indices has improved as non-tech sectors finally start to outperform. De-escalation of some trade risks has helped. The reversal of planned U.S. tariffs on the European Union and a framework that avoided a 10% tariff shock on Europe removed a potential hit of roughly 0.7% to European GDP and lifted global risk sentiment, feeding into positive earnings surprises and a roughly 0.5% S&P rally in early trading. Even so, this bull market is expected to remain volatile, with multiple 5 to 10% pullbacks likely along the way. Investors will be watching whether small-cap earnings and credit conditions can justify the outperformance, and whether today's broader leadership persists or snaps back toward a narrower group of AI winners. Turning to the headwinds, de-dollarization and bond market fragility are a central medium-term concern. Central banks have been large buyers of gold, helping drive prices up by roughly 2/3, and major institutions have trimmed U.S. Treasury holdings, signaling a gradual diversification away from dollar assets. Several countries are actively rebalancing reserves, and there is evidence of declining global confidence in dollar-based assets. At the same time, analysts argue that treasuries are no longer the reliable portfolio diversifier they were in prior decades, as correlations with risk assets have risen in this higher yield regime. Recent price action underscores the fragility. A sharp sell-off in Japanese government bonds and rising Japanese yields have intensified global competition for capital, driving U.S. Treasury yields higher and exposing thin liquidity at the long end of the curve. The 30-year yield pushed toward 5% before retreating, and history shows that spikes in bond volatility quickly transmit to equity volatility. Even though one key bond volatility index is currently unusually calm, that may understate underlying inflation, fiscal, and recession risks lurking beneath the surface. Investors are responding by favoring front-end Treasury exposure for safety and liquidity, while selectively diversifying into bonds from fiscally stronger issuers such as Germany, Canada, Australia, Norway, and Singapore, albeit within the limits of market depth. The end of the 40-year secular bond bull market and worries about sovereign debt sustainability mean that term premia could remain structurally higher, and episodes of bond market stress are likely to continue shaping risk sentiment. Auction results, Japanese policy signals, and ongoing flows into gold will be key indicators of how far this de-dollarization and bond market story runs. Another major drag on sentiment is persistent geopolitical tensions and fragmentation. Even as some tariff threats have been withdrawn, underlying diplomatic trust between the US and Europe has been damaged by disputes over Greenland and broader trade rhetoric, leading the European Parliament to delay ratification of a key trade deal and prepare retaliatory tariffs. More broadly, the world is moving toward a multipolar structure, with China as a credible economic and military rival and swing states like India and Gulf countries shaping outcomes. This challenges long-standing Western economic and security frameworks and raises uncertainty around future rules of the game. The Russia-Ukraine war remains unresolved despite some progress on security guarantees and reconstruction plans, and incremental Russian advances underscore the human and economic toll. In parallel, geopolitical competition is intensifying in the Arctic, prompting coordinated security efforts among northern countries and a central role for NATO. Defense spending is surging. Germany plans roughly €90 billion of additional outlays by 2029. U.S. military budgets are projected to jump from over $1 trillion to around $1.5 trillion next year, and NATO as a whole is set to add more than $1 trillion over the decade. Governments are also stockpiling and reshoring processing of critical minerals, embedding a lasting geopolitical risk premium into energy, metals, and key supply chains even as these trends create sector-specific opportunities. The final key risk is AI and semiconductor valuation risks. A leading semiconductor exchange-traded fund is trading about 25% above its 200-day moving average and at all-time highs, while several chip stocks have rallied sharply on AI enthusiasm. One major chipmaker has seen its share price climb more than 80% last year and another 40+% this year, even though consensus earnings estimates have barely moved, and its latest guidance featured flat earnings per share and a revenue range below expectations, prompting a notable share price drop. In private markets, venture capital is aggressively funding early-stage AI companies at very high valuations, and one prominent AI firm is seeking more than $50 billion at a potential valuation approaching $840 billion, with talk of $1 trillion listing despite the absence of profitability. At the same time, there is a clear gap between AI's transformative promise and today's business impact, with many companies still seeing incremental rather than step-change improvements, and competition is intense. While structural demand for memory, advanced chips, and AI services is strong, these stretched valuations leave little room for disappointment, making earnings seasons and adoption metrics critical barometers for whether this theme remains a tailwind or turns into a source of sharper corrections. To sum up, today's risk sentiment is cautiously risk-on. Resilient U.S. growth, disinflation, an AI-driven capex boom, and a broadening equity rally are supporting risk assets, while de-dollarization, bond market fragility, geopolitical fragmentation, and rich AI-related valuations keep downside risks firmly in focus. Markets are rewarding exposure to genuine growth and productivity, but are quick to punish weak balance sheets, overstretched stories, or policy missteps, so monitoring the interaction between macro data, bond volatility, and AI earnings delivery will be crucial in the weeks ahead. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.